So now we're going to go through what is called options moneyness, because there are terms that you need to understand. And when we're talking about the option being in the money, out the money, or at the money, you need to understand what that actually means. Okay. So here I'm going to give you an example of Apple, and let's say the stock price is at $120. Okay. In this scenario, for the call side, right? The call side, remember on the call side, we want the price to go up, right? We want the price to go up, okay? So when we talk about in the money, there is in the money. This means that the option, the strike price, okay, is less than the stock price, okay? So the stock price is more than the strike price otherwise, okay? Same thing, synonymously, right? That means if the stock price is at $120, the $117, $18, and $19 options are in the money. What does that mean? That if this option expires right now, the option is going to expire in the money. There is a value to it. Okay? There's a value to the option. It can be exercised. Because remember, at the end of the day, when you buy a call option, you have the right to purchase 100 shares, right? So let's say that the stock price is at $120, then you would have the right to purchase the Apple shares at $117 if you have the $117 call option, or $118, or $119. And this is cheaper than the $120, which is where the stock is trading at. So that's why we call it in the money, because even though the price of the shares are at 120 currently in the market, this option will give you the ability to purchase the shares at $117 or $118 and $119, which is, this is a $3 discount, this is a $2 discount, and this is a $1 discount. I know some of you are thinking like, huh? You mean I can buy the shares for cheaper? How does that work? Well, you're paying a premium to do so. Remember that. Because the call option will have a price. Okay? And so that's how the valuations of options are created, based on the strike price, based on a variety of different factors. Okay? So maybe the $117 call option is, let's say, $2.70, right? If you add the $117 plus the $2.70, that will give you $119.70 as the total price that you will pay for the shares. And that means that you're getting the discount of the shares at 30 cents. Okay? That's why we call it in the money. All right? Now, if you're at the money, what does that mean? This one's simple, right? It means the stock price is equal to the strike price. But however, remember that there will be a price of the contract, right? So chances are you end up buying the shares if you were to execute the contract or exercise the contract. The chances are that the price of the shares will be higher, right? Because there will be a price to this contract, the $120 calls, okay? Then the third is called out the money. Out the money is when the stock price is less than the strike price. That means you would buy this option when you think Apple is going to that price, right? So these contracts are typically the most expensive in relative terms, right? In relative terms, this would be somewhat expensive, and this would be the least expensive. This is when you're comparing the whole option chain, right? Okay. So when we talk about out the money, if the contract expires here and the stock price is $120 when at expiry, right? Then you cannot exercise this 3 contracts. Why? The stock price is not at 121 or 122 or 123, right? So these contracts will have no value. They will expire what we call worthless, okay? Because they cannot be exercised, right? The stock price is at 120. You bought a contract or a coupon to buy it at 121 or 122 or 123, but the stock price is not there, so how are you going to exercise it? right? So you cannot exercise those contracts, okay? Now, on the put side, this whole scale is flipped, okay? It's flipped. So here, remember, because you want prices to come down, so now the out the money contract is going to be further away from the strike price, right? This way, going up. In other words, when the price is going lower, right? And then the at the money contract is still the same, but the in the money contract will be the contracts that are at a higher price, right? 121, 122, 123 will become in the money. Why? Because you want to sell the shares now, right? So when you want to sell the shares, you want the contract to be in the money, okay? Excuse me. Now, let me give you an example on the chart once again, and we'll use Coinbase again, right? Simple. So if Coinbase is trading at $61, for a call option, the $70 strike will be out the money, right? The $61 strike will be at the money. And the $50 strike will be in the money. Okay? Simple. For the put option, this is now in the money. This is still at the money. And this is out the money. Right? Because this is where you are, right? For a call option, this is where you want to go. For a put option, this is where you want to go, right? So you want prices to go upwards this way, and you want prices to go downwards this way, right? It should be simple and clear by now. Okay. So now that you understand this, you need to also understand that there are intricacies with how the market dealer works. Okay, so your broker, for example, and I've spoken about this in different previous modules. But remember that when you buy an option, your dealer has to offset that risk as well. This is called delta hedging, or also gamma hedging. Okay, but what the heck is delta and gamma? Well, I'm glad you asked. We're gonna answer those questions in the next video. So tune into the next one right now, and we'll get into it. We're gonna go through the Greeks.